You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
So if you look at the average American baby boomer stepping into retirement right now, they have roughly $249,000 saved up.
Right, which is, pretty specific number.
Yeah, and it took them, on average, like 40 years of labor to build that portfolio. But, and this is why we're doing this deep dive today, if you look at the math presented in the latest FinHabits data and some recent Motley Fool research, you can mathematically match that lifetime of savings using a weekly capital allocation that is so small it barely even registers.
Oh, absolutely. It's almost invisible.
We are talking about $25 a week. Just lean in for a second, because I know this sounds like a massive, well-kept secret that most people overlook because, frankly, it seems too simple to be true.
It really does sound absurd on its face.
Yeah.
I mean, when you frame wealth accumulation for a sophisticated audience, the expectation is always that the strategy is going to involve, complex derivative trading or
leveraged real estate syndications.
Exactly, or at least some highly optimized algorithmic trading model. We're totally conditioned to believe that moving the needle on your net worth requires this agonizing complexity. But the architecture of compound growth, it doesn't care about complexity at all. It just cares about time and consistency.
Right. And the data proves this out in a way that really forces you to rethink capital efficiency. Let's actually look at the FinHabits math right up front, because when I first modeled this out, the disparity between what you put in and what you get out was staggering.
It's the quiet magic of the whole system.
Yeah. So if you allocate $25 a week into a vehicle yielding an average 8% return, after 10 years, your total out-of-pocket investment, the money you actually work for, is $13,000.
Okay.
But the account value, it's sitting at $18,800.
Which, is a respectable nominal gain. You've captured about $5,800 in completely unearned capital.
Yeah.
But the geometric progression is just barely warming up at year 10. The real structural shift, the actual explosion, happens in the second decade.
I ran that second decade, and it's wild. You stretch that exact same automated habit out to 20 years. Still just $25 a week. Over 2 decades, you have manually contributed $26,000 of your own money.
Right.
But the account balance has escalated to roughly $62,500. You commit 26, you extract over 62.
And that differential, right, that gap of $36,500 is the actual mechanism of wealth generation. It's unearned. You didn't trade your time or labor for it.
You didn't hustle for it.
Exactly. You didn't optimize some crazy tax loophole for it. It's just the byproduct of your capital acting as its own labor force. And the whole mission of our deep dive today is to really tear apart the mechanics of that specific gap.
Yeah, we're pulling from FinHabits, the Motley Fool, Money Cornucopia, and ATI to unpack exactly how this math works. We're going to deconstruct why time is your greatest asset, the specific asset classes you can use to grow this money, and why automating this process is basically the ultimate financial cheat code.
But to do that effectively, we kind of have to start with the fundamental engine driving the entire apparatus, right? We see the output, that $36,000 gap, but we need to isolate the input mechanism. We have to talk about compounding.
Right, but not just the elementary school interest on interest definition.
No. We need to look at it as geometric progression applied to capital markets. The sources use some great analogies here, and I think the Money Cornucopia source uses the snowball framework in a way that really highlights the velocity.
The expanding surface area.
Yeah. It's not just a snowball rolling down a hill picking up a little bit of snow. It's about the surface area of that snowball expanding. When you increase the surface area of your capital base, its capacity to capture market returns increases exponentially with every single rotation.
So the bigger it gets, the more it grabs.
Yes, which explains the back-end loading of compound growth perfectly. The ATI transcript uses a more organic model, like a fruit tree.
Oh, I like that one.
Yeah, in the initial years, the capital base is just the trunk. It's fragile, it's slow. The yield is practically zero because there are no branches yet. But once that initial trunk produces branches, those branches produce their own branches, and then fruit.
Right, and the structural integrity relies on the time it was given to establish the root system, not on, how much water you dumped on it in year 10.
Spot on.
Let's apply some hard numbers to that organic growth, just to make it real. The money cornucopia analysis models a $5,000 initial catalyst. So a single deployment of capital, $5,000, zero follow-up contributions, running at a 7% annualized return.
Okay, let's track it.
At the end of year one, the yield is $350. You're at $5,350.
Well, which, honestly, that nominal growth in the first year is basically a rounding error. It doesn't feel like much. And year two doesn't look that much better.
Yeah.
You capture 7% on the new baseline of $5,350, which nets you $374.
But the architecture begins to scale, right? By year 10, without a single additional dollar of principal put in, the balance crosses $9,800. The initial capital has almost doubled completely organically.
And if we extrapolate that timeline out to year 30, that isolated $5,000 chunk has morphed into nearly $38,000.
Huh.
The original principal is entirely eclipsed by the accumulated yield.
Okay, let's unpack this, because I always hit a cognitive wall when we discuss these specific timelines. We are talking about 30 years to capture the peak efficiency of this model, even looking at the 10-year horizon just to achieve a single doubling of your money.
It feels slow.
It feels incredibly slow. 10 years feels like a lifetime when you're just starting. Is it really worth waiting a decade just to see your $5,000 turn into 10, especially with inflation eating away at purchasing power?
That pushback, that exact feeling, is the most common friction point in portfolio construction. Investors suffer from this duration mismatch. They want geometric returns on an arithmetic timeline. But you have to look at the velocity of the subsequent doubles.
Okay, lay that out.
So the sources reference the rule of 72. You divide 72 by your expected yield to find your doubling period. At 7%, you double every 10 years.
Right, which means the first decade takes you from 5 to 10. Kind of arduous.
Very arduous. But look at the capital velocity in the next cycles. The second double requires the exact same 10-year duration, right? But it takes you from $10,000 to $20,000. You just captured $10,000 of unearned equity in the same time frame it previously took to capture 5.
Oh, wow. Okay, I see where this is going.
Yeah, the third double takes you from $20,000 to $40,000. By the fourth double, you are generating $40,000 of unearned equity in a 10-year span. The duration of the cycle doesn't change, but the absolute wealth generated per cycle becomes staggering.
So the later decades are where it shifts from just a linear slope to this crazy exponential curve. The surface area of the snowball is so massive that one rotation just captures an avalanche.
Exactly, which forces us to confront a pretty brutal mathematical reality. If the velocity of wealth generation is heavily concentrated in the later cycles, any delay in deploying that initial capital permanently amputates your most lucrative compounding years.
And that brings us directly to the urgency of capital deployment. We have to look at the cost of waiting, because every day you wait shrinks your runway. The Motley Fool data models a timeline focusing on a slightly different contribution rate, $100 a month, which, by the way, maps perfectly to our $25 a week framework.
Right, same annual outlay.
Exactly. So if you consistently invest $100 a month and earn a 10% return for 30 years, the terminal value is $226,000.
And this is where we return to that boomer statistic you opened with.
Yes. The average 401k balance for the entire retiring boomer generation is $249,300. By simply deploying the equivalent of $25 a week and letting that geometric curve mature over 30 years, you effectively synthesize the lifetime average savings of an entire generation.
It completely destroys the narrative that you need a massive income stream to build terminal wealth. You just need duration. And the money cornucopia source models a scenario that illustrates this duration advantage perfectly. We look at two distinct profiles.
Let's hear them.
Profile A is a 25-year-old allocating $200 a month. Profile B is a 40-year-old who realizes, uh-oh, I'm behind the curve, and attempts to compensate by allocating $600 a month.
So Profile B is deploying triple the capital, absorbing triple the monthly cash flow pain.
Quick break. If you're enjoying all things investing, be sure to follow, rate, and share this episode with a friend who needs to start investing smarter. Got questions? We might answer them in the next episode. Now, back to the show.
Exactly. Yet the modeling shows the 25-year-old will almost always end up richer. The 40-year-old is trying to use sheer capital volume to brute force a geometric curve, but they can never buy back the 15 years of compounding duration that the 25-year-old already weaponized.
The math is ruthlessly unforgiving to delay.
It really is.
This honestly requires a total redefinition of risk. When we discuss risk, everyone immediately defaults to market crashes. We worry about a 20% market correction. But the biggest risk isn't a market crash. The actual risk that destroys the most wealth is the cost of delay while waiting to have enough money to start.
Yes. It's sitting in cash, waiting for the optimal entry point, or waiting until you get a raise to make a quote-unquote meaningful contribution. You are guaranteeing the destruction of your unearned capital by refusing to start the engine today.
Right. So we know we need to start now, but how do we actually structure the habit? Because the sources are incredibly specific about the cadence. They consistently model $25 a week rather than $100 a month. Functionally, it's the exact same money. Why does the weekly cadence matter so much?
Well, there's a mathematical edge and a psychological edge. Let's do the math first. From a purely mathematical standpoint, a weekly allocation reduces cash drag and increases compounding touch points.
Break that down.
If I wait until the 30th of the month to deploy $100, the $25 I earned in week 1 just sat in a checking account, depreciating against inflation for 3 weeks. Week 2's allocation sat idle for 2 weeks.
You are artificially suppressing your capital's time in the market.
Exactly. By deploying weekly, you tighten the feedback loop. Your money goes to work days or weeks earlier. Over a 30-year horizon, eliminating that microcash drag yields fractional advantages that actually compound into measurable gains.
The mathematical edge makes total sense, but the psychological edge, the behavioral finance aspect, is arguably way more critical.
Oh, without a doubt.
The friction involved in a monthly allocation is a massive hurdle. Behavioral economics tells us that parting with a $100 chunk triggers our loss aversion. You sit down at the end of the month, you look at your mortgage, utilities, take out bills, and that $100 suddenly looks like vital liquidity. You feel like you need it.
It creates a massive monthly cognitive load. You are forcing yourself to override your survival instinct 12 times a year. And eventually, cognitive fatigue sets in, and you justify skipping a month.
But dropping $25 a week or even the $19 a week mentioned in the ATI source, it bypasses that cognitive friction entirely. It feels drastically smaller and more manageable. It's the price of a couple of coffees or a takeout meal.
It slips right under the threshold of loss aversion.
Right. I look at it like wading into the pool one step at a time instead of forcing yourself to do a terrifying high dive once a month. 25 a week makes the habit sticky. It demands basically zero willpower.
And in capital accumulation, a frictionless, consistent strategy will perpetually outperform a high-friction, sporadic one every single time.
Okay, so let's pivot to the foundation. We have the listener bought into the $25 a week habit. The liquidity is ready. The immediate question is, where exactly is that money being sent first?
Right, asset placement. The FinHabits framework is very dogmatic about this sequential staging. Before you expose a single dollar to the stock market, you must establish a baseline liquidity buffer, basically a 1 to 2 month buffer for essential expenses.
Now, a lot of aggressive investors dismiss the emergency buffer. They say holding cash with inflation is technically losing money.
Sure, technically it's a negative real yield. But the FinHabits rule isn't about yield, it's about structural defense. It's defending the compounding curve.
Because if you operate without a buffer, you are forced to sell investments to fix a flat tire.
Exactly. If your transmission blows and all your money is lost in equities, you have to liquidate assets to cover the repair. And if you are forced to liquidate during a market dip, you are realizing a capital loss and permanently resetting your timeline. The cash buffer is a firewall.
Okay, but where we store that buffer is critical, because the Money Cornucopia source details this scenario where an investor held $1,200 in a legacy traditional savings account, yielding an APY of 0.01%.
Right. They were staring at 14 cents a month in nominal yield.
14 cents, that is offensive.
It's a systemic inefficiency. The big banks know consumers are too lazy to move their money, so they sweep those deposits into higher-yielding debt, capture the spread, and throw you pennies.
So the immediate correction is high-yield savings accounts, or HYSAs. They have fundamentally different overhead structures, usually digital first, so they pass the yield directly to you. We are looking at rates hovering around 4.5 to 5% right now.
The source actually highlights a case study with an investor named Tariq to quantify this spread, and it's a great example. Tariq held $8,000 in a legacy bank for 24 months, and he made a cumulative yield of $16.
Wow.
Yeah. He migrates that exact same money to a HYSA yielding 4.75%. The first-year yield jumps to over $760.
That isn't just optimization. That is a meaningful cash flow injection. $760 is real money. Now, for capital that sits between the emergency buffer and the long-term stock market stuff, say, money you won't need for 6 months to 5 years, the sources introduce certificate of deposit ladders, CD ladders.
Great, CDs are fascinating. You are trading liquidity for a guaranteed yield by locking the capital up for a fixed duration. But locking up all your money at once exposes you to duration risk. If rates go up while your money is locked, you lose out.
Which is exactly what the CD ladder fix is. Let's break down Priya's $10,000 case study from the text. Instead of locking all 10 grand in a single 2-year CD, she splits it up.
She fractionalizes it into 4 equal $2,500 rungs.
Right, a 3-month, a 6-month, a 1-year, and a 2-year CD. This solves the liquidity problem beautifully. By staggering them, she ensures a chunk of cash frees up every few months. She earned $482 in interest while keeping rolling access to the cash.
And if she doesn't need it when the 3-month matures, she rolls it into a new 2-year CD at the back of the ladder, constantly capturing the higher yield while maintaining rolling liquidity.
Now, briefly, the sources also touch on money market accounts as a middle ground here, right?
Yeah, money market accounts basically give you near HYSA yields, but with check writing and debit card optionality. It's a good hybrid if you need slightly more transactional access to your buffer.
But look, savings accounts and CDs protect your money, but the stock market is where the real compounding magic lives for long-term wealth, like anything over 10 years. We have to migrate up the risk curve.
Absolutely. The equity markets are the engine room. But the immediate reflex for most people is active stock picking, trying to find the next Apple or Tesla. And the consensus across all our research is that deploying your $25 into individual stocks is a mathematically flawed strategy.
Right. The risk is too high.
Exactly.
Right.
Instead, the FinHabits and ATI frameworks mandate broad market indexing via ETFs, exchange-traded funds, or index funds.
Let's define that really quickly. Instead of gambling on a single company, you are buying a basket of hundreds of companies, like the S&P 500. You are basically buying the entire American macroeconomic engine.
Right. And let's drill down into the performance metrics there. The S&P 500 has historically returned about 10% annually.
But, and the sources draw a hard line here, we have to talk about inflation. It's 10% nominal, but roughly 7% real return after inflation.
It's the silent erosion of purchasing power. A 10% return grows your dollar amount, but over 30 years, things cost more. Your capital buys less. So that 7% real return means your actual purchasing power, your standard of living, doubles roughly every 10 years.
Even with that inflation drag, the absolute wealth generation is staggering. Let's show the math. $10,000 put into an S&P 500 vehicle, left completely untouched for 30 years, becomes roughly $174,494.
And if you add that recurring $200 monthly injection, our weekly $50 equivalent, it pushes it over $430,000.
Now, for the DIYers who want ultimate broad diversification, the ATI advice mentions the 3-fund approach, or target date funds.
The 3-fund portfolio is so elegant. It uses 1 U.S. stock fund, 1 international stock fund, and 1 bond fund. You basically own the entire investable global market.
And if that's too much work, target date funds do it all for you. You pick the year you want to retire, and it automatically adjusts the risk as you get older.
It's total cognitive offloading. But I have to bring up a specific feature here that I get really excited about. What's fascinating here is DRIP, dividend reinvestment plans.
Yes. Let's explain DRIP, because this is where the geometric progression shifts into overdrive.
So we know companies pay out dividends. Right. Historically, that cash would just sit in your account doing nothing. But with DRP, you automatically use that dividend to buy more fractional shares of the fund.
Let's use the example. You have 100 shares at $50 a share. That's $5 grand. The fund pays a 3% dividend, which is $150.
By activating DRP, the brokerage automatically uses that $150 to buy 3 more shares. So now you hold 103 shares.
Right. So next time they pay a dividend, you're getting paid on 103 shares, not 100.
Exactly. This creates a compounding snowball that can accumulate 30 to 40% more terminal wealth over decades. It's synthetic compounding at its finest.
Okay, I have to play devil's advocate here, though. So if the whole market tanks, my diversified portfolio tanks too, right? How is this any safer than just picking a really good, safe company and riding out the storm?
The distinction lies in the difference between volatility and permanent capital loss. If you put all your money in one fortress company, you are vulnerable to it going bankrupt. Think about Blockbuster or Sears.
Right, they went to zero.
Precisely. But a broad market index is self-cleansing. If a company fails, it drops out of the index and is replaced by a growing one. The broad market has historically always recovered. You might see a 30% drop, that's volatility, but it won't go to zero unless global commerce ceases to exist.
Right, volatility is just the toll you pay for the yield.
Mhm.
Okay, so once that foundational equity engine is running, what other vehicles use this compound magic? Section 6 of our deep dive gets into advanced avenues.
Yeah, alternative assets.
Mhm.
And the most prominent one discussed is real estate, specifically REITs, real estate investment trusts.
Because getting real estate exposure directly is a nightmare. You need a massive down payment. You're a landlord fixing toilets at 2 a.m. REITs let you get the exposure and the dividends without the operational headache.
Exactly. It operates like a mutual fund, but for income-producing commercial real estate.
Oh.
And they are legally required to distribute 90% of their taxable income back to shareholders, which means huge dividends.
Which are perfect for the DRIP strategy. The case study here is a colleague who invested $300 a month into a REIT from 2018 to 2024. That's $19,200 in contributions.
But the value in 2024 was $32,000. The price appreciation and the drip turned it into a massive gain.
We do need to warn people, though REITs are hypersensitive to interest rates. When rates go up, their debt costs explode and the share prices can drop, so keep an eye on that.
Very true. The sources also mention bonds and I-bonds as fixed income alternatives that automatically reinvest. I-bonds specifically are a massive inflation hedge.
Yeah, they hit a massive 9% yield in 2022 when inflation was raging. It's a great tool to protect purchasing power, even if there are limits on how much you can buy.
And finally, farmland. Platforms like AcreTrader or Farm Together.
This one blew my mind. High historical returns, like 10% plus since 1990, driven by land appreciation and rent. But it's for accredited investors only, and it is highly illiquid. You can't just sell your farm shares on a Tuesday.
Right. It's a potent tool, but reserved for later in the journey. Which brings us to the invisible hand of this entire operation. We have the strategy, we have the vehicles, but human nature is the biggest enemy of compounding. How do we bypass our own worst instincts?
Automation. The magic only works if it's automatic. If you try to do this manually, you will skip it when life gets busy or money feels tight. You'll say, oh, I'll double it next week, and you never do. Automated investing compounds silently in the background while you live your life.
And this automation forces you into the most crucial concept in investing, dollar cost averaging, or DCA.
Explain DCA for us.
It means investing a fixed amount regularly. When you do this, you automatically buy more shares when the market drops and fewer shares when the market rises. You become completely detached from the news cycle.
This is a crucial point. Everyone gets the urge to pause contributions during a market dip. They feel like they're throwing money into a fire. But mathematically, a dip is actually when your fixed $25 is working the hardest.
Yes, you are accumulating assets at a steep discount. Pausing during a dip is the most destructive thing you can do. And we have the JP Morgan reality check to prove it.
Oh, this stat is devastating. Over a 20-year period, the market returned roughly 10% annually. But the average retail investor, they only earned 2.9% annually.
It's purely because of emotional buying and selling. They panicked during dips, sold at the bottom, and waited too long to get back in. Automation removes the emotion and makes you a cold, calculated accumulator.
But beyond our own emotions, we have to protect the automation from fees and taxes. Keeping costs tiny matters so much.
Oh, absolutely. A 0.1% fee versus a 0.75% fee sounds like a rounding error. But over 30 years, that higher fee will cannibalize 20 to 30% of your total wealth.
And taxes. You have to utilize tax-advantaged accounts. Get your 401k match first. That's a 100% free return. Then look at the Roth IRA. The Roth IRA lets your money grow completely tax-free, and you don't pay taxes when you pull it out in retirement.
It's the ultimate vehicle for this strategy.
So, question. If I set all this up, the Roth IRA, the low-cost index fund, the DRIP, the weekly automated transfer, do I just literally never look at it again?
Basically, yes. The optimal ongoing requirement is about a 30-minute review every 6 to 12 months. You log in, make sure the transfers are still working, and maybe increase your contribution if you got a raise. Otherwise, hands off.
That is incredible. Okay, we have covered so much ground today, so we are at the outro, and I want to lay down a direct challenge to you, the listener, based on everything we've talked about.
The threshold to start has never been lower.
Exactly. Pick one amount today, even if it's just $10 or $19 or $25 a week. Go online, automate it right now into a broad market index fund, and promise never to touch it. It is the absolute most boring yet most powerful financial decision you will ever make in your life.
It really is. And I'm going to leave you with a final thought to mull over. We spend so much time worrying about whether we are making the quote-unquote perfect financial choice. We paralyze ourselves researching the perfect fund or the perfect entry point. But in investing, a good enough choice made today will mathematically obliterate a perfect choice made 5 years from now. The alpha is in the immediate execution.
The perfection is in the starting. Thank you so much for joining us for this deep dive. Go automate your $25, and we will see you on the next one.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.